Welcome to the podcast. Today, Scott clicks on some random links. Let's get into it. Wealthlab fam, we're going to get into a little look under the hood about some of the dumb emails that Phil and I receive from different investment managers. And today's the day that we get into it. So without waiting further, let's go. I know it was a bit of a clickbaity title, but Phil and I are in the process of building our, what we're referring to this as Anchor Point 5 portfolio. And this is a portfolio within our investment suite, which is the ultra high growth, ultra high risk option. And when I say risk, I just mean volatility. So we've got our balanced conservative growth funds, and we're looking to add an additional fund that's got a little bit of Bitcoin exposure. It's got some leverage in it. So what Phil and I are doing is we're in the process of doing our information search. So we attended a conference last week, 2 weeks ago.
Yeah, last week. Yep.
It was 2 weeks ago out in Torquay. Where a bunch of different investment professionals came together, and it was basically just a networking session of ideas. And we met some managers that we really liked. And one of those guys followed up with the most preposterous email. So he sent it to me, and I was just like, oh, perfect trading opportunity for Dan, our junior advisor. So Dan is in our professional year, and he's going to be coming on to being our financial planner next year, so 26. And I first of all was like, mate, this is perfect for you, just for an example of sometimes when a sales guy sends you something amazing, you clearly need to be mindful of it. But you know, me and Phil were just talking before the podcast, and we were saying how I'm sure if you're in concrete, you get some silly emails from product providers who are in concreting.
Yeah. Got the best aggregate.
Yeah.
Me truck spins faster. I don't know. What's
Rebar. Yeah, this is not our world, is it?
Yeah.
Spins faster?
Yeah, I don't.
So then I thought a bit more about this, and as I was like talking down through this, I was like, you know what, this is the most like perfect podcast content. Because Dan asked me the question, he goes, "What are you going to say?" And I was like, you know what, I'm going to respond. I'm actually going to get rolling with this. So, look, here we go. Here's the email that I received. Hi, Phil and Scott. Hope you had a great weekend. Reaching out to continue the conversation post X conference. We've been working with some of the top private wealth firms nationally as part of their private market allocations. Sorry, achieving superior returns. At X, we've been able to deliver 28% per year over 27 years in our flagship funds, plural. So that's interesting. So is that 2 funds? Is that 3 funds? Is that 1 fund? Unclear. I'm coming down to Victoria on the 9th and 10th of October if you've got some time to catch up. What do you think, Phil?
Oh, sure. 28% returns. I mean, why aren't we all doing it?
Oh, 100%.
Yeah.
So
sounds great.
So I responded. No, actually, here's the first thing I did is I basically plugged his email into ChatGPT. And the email goes into ChatGPT like this. Theoretically, if I put $50,000 and I compounded it at 28% over 27 years, do you want to take a guess how much money that would be worth? You can give it away. It's some silly number. So if we put 50 grand in and it compounds at 28%, it becomes worth, drum roll, $54 million.
Pretty comfortable retirement.
It's kind of interesting because the difference is because it goes to year 10, 586,000, at year 20, 6.9 million, and then 7 years later, 54 million.
I mean, sure. Compounding's great.
What I found was quite interesting about this was ChatGPT gave me every single warning it possibly could around being mindful about not getting scammed. And I thought, oh, that's interesting. That's quite good. Because it was just like, it was like, this is highly risk, and it doesn't talk to you about the liquidity. It doesn't talk to you about the fees. It doesn't talk to you about the past record. It doesn't talk to you about if you're a wholesale or sophisticated investor. I thought that was quite interesting. It was trying to warn me off.
There's some more numbers there. There's no denying that.
Oh, 100%. I proceeded forwards. Cool compound growth. So I actually just send it. And then I just go, thanks, Block. Interesting growth figures. A full stop, nothing else. Hit send. Compound interest. It doesn't say hello. There's no greetings.
I mean, you wouldn't have got a greeting out of me either after that, but sure.
Compound interest. The 8th wonder of the world with 2 exclamation points in a weird space. Good you have an eye on the portfolios. Happy to assist where I can. And then he signs out. When it comes to building appropriate portfolios that are not silly, we did some more research, and then we looked at the FAAA, which is the Financial Planning Association of Australia, and they say a normal return for a growth fund should be around about 7% over a 10-year time frame.
Yeah.
I did a little bit more digging. If you just in the financial review today, there's someone talking about just for example, Australian Super has done 7.94% over the last 10 years. He also talks about here how the past 3 years have been above average returns, which have dragged this return higher. So this we'll call it 7.9% from Aussie Super have actually been dragged higher by above average returns.
Yeah.
And I was reading this article in the context of there was another advice firm that was adding some silly to suggest they were saying that such and such investment was going to achieve 15%.
And they're using for like long-term retirement modeling, like over a 30-year period. It's just not reasonable.
Yeah, it's just not possible, because the way that the markets work when the above average returns exist, they're competed away. It's just that's just how markets work. So if there is a investment that's strong, people bid up the value, which then reduces the return, and that's just how any market would work. Same thing is if you see something's on sale, you'll probably buy it, which will then reduce the supply, which then pushes the price up over time.
Yeah, exactly right.
So Chat West, which is another large sort of like a ratings financial business, was saying, again, they're just reiterating the expected return of 7% over a 10-year time frame is achievable, assuming that you're comfortable with some movement.
Yeah, which is fair. And it just does raise the point, you work in financial advice or any kind of investment management type capacity, you get sent a lot of stuff, and like any sales guys, the financial sales guys are no different to anybody else's. They'll spin whatever data's out there to suit whatever their narrative is. You need to have a pretty strong bullshit radar when you're putting together this stuff. And when we are building our portfolios, I'm not just standing here throwing some darts at a dartboard and then we just get whatever we land on. We do a lot of due diligence. There's my research assistant just sticking her head in the door there. Must be home from school time. But yeah, we do a lot of due diligence. And if we can't understand what's in a portfolio or how they're generating these returns, well, straight away, there's got to be some alarm bells ringing, Scott.
I completely agree with you.
I remember there was one I had put in front of us not too long ago, actually, which was proposed as a diversified managed fund, well spread around. But actually, when I tried to dig into where's the money invested, it was nearly impossible to find what the underlying investments were.
Oh, really? What was it?
Well, it was still very difficult to decipher. I mean, the equities and stuff was straightforward. Just there was some Australian stocks and stuff that you'd expect, very vanilla stuff. But then I actually had to dig out their audit reports from previous financial years to try and get some sort of a look at where this money was going. And all of a sudden on these audit reports, I see all these payments going to these different private equity firms, property development trusts, all this sort of gear. Second I saw that, we're out, You've got to know where to look for some of this stuff. And when they're telling you a story that's too good to be true, it's probably a reason.
Yeah, look, I bang on this all the time. This grey line that I've just drawn is a hypothetical risk return. So if we say a return of, say, 7% is like, say, here, 7%, but you can get what's referred to as almost a risk-free type return. But what we can do is that every 12 months, you're trying to get things that are kind of in this range. So investments look like this. They actually look like bullets. They don't look like lines. And this would be, say, 4%. 4% return is effectively no risk. If we move to a 7% return, we're actually taking quite a lot of risk. We're taking stock market risk. We've got international shares. We've got some small cap shares. It's only a 3% return difference, but actually from a risk level, it's like a parabolic difference in terms of effectively none. We're going to have some movement here. We're definitely going to have some changes. Then if we take another step out for here, trying to chase something at 10% return, this is a further quantifying of risk. So it effectively cubes our risk. And by that it's just like how much volatility have we got in the portfolio, and it moves something like that.
Much up in the end you're going to have.
Yeah, correct. If you're trying to throw me something that's off the scale, what is it from memory? It's like this line. This is taking me back to my economics degree. Stays, and then 27%. the gap here on how much it's expected to do this in the future, post fees, post return, is a joke. So it's not something that we're going to be adding a high allocation to. It's not something that we're going to be going deep into. But after thought, we are looking at grabbing a portfolio with expected return. So this Anchor Point 5 portfolio will be in, say, the 10 to 12% range targeted. But to achieve that, there's a fair bit of volatility. Before I move on, Phil, what were you saying? I didn't want to cut you off.
No, you're right. I was just going to say the other thing that's like just really important to think about when we're talking about this stuff is you'll see when you're looking at investments, you'll see people talking about shares as being a risky asset or property or whatever. The assets have more volatility, but it's also super important to recognize the fact that actually, even within those asset classes, not all risks are the same. You know, the risks of owning a big four bank share versus a tiny startup mining share, they're both shares, but those risk profiles could not be more different. So just because you're in a share fund does not necessarily mean that guarantees the level of risk you're taking either. You need to understand what's their style, how's it invested, how's it work, you know?
Old mate Nazar's got a bad headshot, but he's basically saying anything with double-digit returns. Yeah, it's not a great, but he's right. Going from a 9% return to something like 12, you're probably taking anywhere between 50 and 60% more risk.
Yeah.
So this is what another professional saying the exact same thing, and I completely agree with him. Now, on that note, what would it look like if we were to build something that was trying to build some high performance funds? Well, I'm glad you asked, dear reader. Here's an example of a fund that we are not. And I need to caveat this in the strongest possible way. I'm not recommending this. We do not have this in our funds, and this is not a fund that we are going to use, because I'll go into some more details behind on why we don't in a second. But this is a geared equity fund, meaning it's gearing. So for whatever the S&P, the ASX, so whatever the stock market does, the 200 biggest companies in Australia, it will do twice that. So the S&P did 3% last month. It did 6% last month. The S&P did 7% return prior 3 months. It did 14% return. Is this making sense?
Yeah. Well, I might just jump in quickly and just explain some of the financial planning jargon we just used. Gearing simply means borrowing money to invest. It's not.
And this could just as easily be minuses. So if the stock market was down 3%, it'll be down -6. If the stock market was down 7, it'll be down -14. This is a double-edged sword. Everything goes up, goes down. Now, the reason we don't use this in our portfolios is there's a thing called time decay. I won't get into the Greeks of options theory and pricing, but there's a reason why these figures here are not exactly correct. So, for example, the 3-year return of the ASX is 13%, but the 3 return of this is only 21%. That's because there's a gearing cost, and there's also a gearing drag that occurs here as well. So that's why I don't use this fund, because on a day-to-day basis, it doesn't quite work. But if you wanted to have I'm going to call it a giddy up investment, this is how gearing works. This is just the power of it. And I'll just zoom in on just the movement. So this is in orange line. The orange line is the performance. The red line is the underlying asset. It's going to give you just exactly leverage exposure. So if we go, for example, from here to here during COVID, the stock market had roughly a 30% drawdown, something like that. So the ASX dropped by about 30% in this time frame. This fund had almost a 70% drawdown in the space of like 8 weeks. So it was like right there, -70.
Not going to be a bloody good show if you invested at the bottom of 2020 there, though. Happy days.
Oh, you look like a champion. So if you had invested in 2014 and today the ASX is up 156%, and this fund is up 248%. There is moments of terror with these type geared funds, but if you believe that the long-term benefits of the stock market are up, this will perform better than the ASX. Again, articulate this is not in our portfolios, because there's more effective ways to get access to leverage investments that we will be building into our Anchor Point 5 product. But I just thought I would show you of like, here's an actual fund that's not a black box. You can actually see the underlying, and it's liquid. It's not safe, but you're able to fully sell out. Like even right here at the scariest moment, you still would be able to get your money out.
Yeah.
Which is really important.
100%. Black box is a good one. Yeah.
High risk managers like these are like the mate who bets everything on black at the casino and swears that he's got a system. He comes back with enough and then comes back only with enough money with a sausage roll. There were a bunch of funds like this that did offer these types of performance figures over the years, but they were what we're going to refer sausage roll money, e.g., you just get cents in the dollar back. And look,
I like that. I like that. It's like
what's
throwing on the
good-
box trifecta that costs you more than you pay out.
yeah, it's always funny when someone comes to you and they'll be like, "Hey, I've been gambling. I've got some winnings. That's great, but what's your losses?" Over to you guys. Do I take a meeting with this guy offering silly returns, or do we just call it? I'm interested to hear your feedback. If you guys think I will, send me a message. If you've seen something advertised for that's like a high risk investment, screenshot it, send it in. I want to have a look. I want to talk about it in the next month's podcast.
Yeah, we do like
And
these things. It's almost like a sport around here.
yeah, isn't it? And thanks, guys. Have a great day.
Cheers.